All right, welcome everybody. I'm Jennifer Langley. I manage our Southeast chapters of the CFO Leadership Council. We have 27 chapters nationwide, and I love the Southeast, of course. I'm based in Atlanta and started the chapter here about 5.5 years ago, and since then we've opened up. Jacksonville was the next one, and then we had South Florida, Charlotte, Nashville, and now there's talk of Raleigh. So we'll see what happens with that in this virtual world that we're in. I also manage and oversee our conference, and it's coming up this November. It's going to be actually a 3-day virtual conference from November 11th through 13th. So I hope you all plan to attend that, and please reach out to me with any questions about that. Just a few housekeeping things. We're going to kind of mute the lines in just a minute after we do the introductions, just so that we can hear the panelists. And I'll probably just turn your videos off too, just to focus on the panel speakers today. And then after that, I definitely would like to open back up, and for anyone that would like to stay on and ask questions following their presentation. And during the presentation, of course, ask questions through the chat. We do have to do polling, so we will. I'll be sharing a polling question every about 15 minutes through the program. And for those that take CPE, you definitely want to answer those questions. And so now I'll turn it over to our fabulous co-chair, Mindy Barker, and she's going to share some other welcome remarks with you.
Good morning. Thanks to everyone who joined us on the webinar today. And thank you for your continued patience as we do these webinars remotely. And I think back in March and April, we would have never dreamed that we would be doing this at the end of August, but here we are, and we've all persevered. And what you're looking at on our screen right now is our fabulous steering committee. And each one of these individuals have participated and provided their network and their expertise to help us develop this terrific programming that has drawn all of you here today and impacted many others. There's so much dynamic information going on right now. It's hard to sift through what is worth your time and what is not, because most people that I talk to in the financial world, we're all working probably more than we were before. So to join a webinar, it needs to be beneficial for you. So not only do we get CPE here, but we get quality education. And thanks to these individuals for helping facilitate that. And upcoming events, September 15th, we have the technology, and that's always, I mean, technology changes almost every day. So we need to stay up on what the technology is so we can have facilitative conversations with the C-suite about what we should be spending our money on. Successfully in managing your newly remote workforce, that is definitely difficult to do these days, and we all need to learn tips and tricks and streamlining the process for customer service. We're all customer service officers within the organization, so as finance leaders, it's great to learn that. At this point, we're not sure that we're going to be able to gather together for any of these meetings. We're just taking it day to day. And again, we appreciate your patience on that. But you can also be guaranteed that it will be worth your time, whether in person or online. And then thank you to our sponsors. Our sponsors have been absolutely fantastic during this pandemic. Everyone has stayed with their commitment to the CFO Leadership Council, not only with financial sources, but they've gotten very creative to provide content for us to keep us informed and keep it interesting. And we sincerely do appreciate that. And I'm going to open up the floor to people that are on the line that represent these sponsors, if you'd like to say a couple of words, and start off with Greg Smith of Bank of America.
Thank you. Good morning, everyone. We're delighted to continue to support the Leadership Council for CFOs. It's really an important organization where we stand very strongly committed to our business relationships here in Jacksonville, and we think this is an important way to be part of that. So thank you all.
Okay. Anyone else on the line that represents a sponsor that would like to speak?
Hi, everybody. This is Angie at Cindo. Good morning. I just want to let everybody know the positive news that we are taking off and we are slammed. We have so many open jobs right now, and it's quite the opposite of what people think. So I don't know, it's just exciting times and super positive after a pretty low and depressing year, to say the least.
Great news
That's
is
great.
that.
That's great.
But
Good
thank you
morning.
for explaining.
I just wanted to say thank you as well. And I really think that this is a timely topic, and I appreciate both the bankers and Baker being available to talk about this as we continue to navigate what's happening with COVID. That's exciting news from Angie's end, and hopefully we can help figure out how to talk to our bank so we can afford to hire all these new people. So thank you.
Good morning, this is Lee Mills, and I'm with One Digital Health and Benefits. And as we are entering in the renewal season for a lot of health and welfare benefit plans, we just want you to know we're here as a resource for you. We are local in touch, but national in reach. And we actually help clients from 10 employees to 10,000. So don't think that you're too small or too big. If you need some assistance, we're here to help.
Hey, anyone else would like to speak?
Yeah, hey, Mindy, this is Hank Catalino, and I'd echo Angie's comments. Although the first quarter was very bad, business has really picked up. Our customers and then prospects now have really seen the need for planning, especially with these unplanned things like COVID, and the importance of reforecasting and understanding where your business is going has really been important to them, and that's what we do. We help organizations plan. So we're happy to be a sponsor, and we think this is a great forum for thought leadership and best practices.
Great. Yeah, we all need a plan, that's for sure right now. So Lippis Matthias, would you like to speak? Okay.
Good morning. I'm so sorry. I'm actually misrepresented. This is Shannon Peabody. I think I might be taking Chris Walker's his line. Chris is the partner in charge of the Jacksonville office. But on behalf of Lippis Matthias, we're proud to be a sponsor once again for the CFO Leadership Council in Jacksonville. And I'd like to take a special shout out to Barbara Cosiolo, who is on the panel today. Speak and to share her knowledge, but to give some background for Lippis, we are headquartered in lovely Buffalo, New York, but we have an expansive footprint throughout the East Coast of the US and locally here in Jacksonville. We are a full service business firm with a focus on commercial litigation, real estate, and any type of business issues for individuals and corporations. So with that, I will give it to you, Mindy.
Okay, thank you. And Julie, would you like to speak on behalf of OnPay?
Good morning. Good morning, everyone. I'm Julie Betty Anderson. I'm the Chief Operating Officer at OnPay Solutions. We're a business-to-business payment technology company, a fintech, so to speak, that helps businesses automate their accounts payable and their accounts receivable. And we're really proud to be a part of this council here, the CFO Leadership Council.
Oh, great. Well, thank you so much again, sponsors. We really sincerely appreciate all that you've done to help with fantastic programming and keeping us all connected. I was just thinking this morning that in a lot of ways, the CFO position, it has enhanced in terms of responsibility and recognition. And this is our time to shine. And we need to make sure that we're armed with the right information and the right way to communicate. So this topic is just awesome. And I'd like to go ahead and move forward so we can get the panel on and they can, also, you can follow us on social media and definitely do that. Post information like this afternoon. If you're just taking a mental health break, repost something that Jennifer posted about this meeting today and talk about why you enjoyed the panel. And it helps all of us if we get more members and more sponsorship, and social media helps with that. And it's free to you to do that. We appreciate it. And you can also become a member if you're a visitor with us here today. And there's an August special with $100 off the premium membership. And there's also the CFO Connect portal where we ask each other questions, and we also, there's jobs posting here. There's videos of all of these fantastic webinars from across the nation. So just about any subject that you need to learn about, you can get on here and learn something about. Definitely worth the money, time, and energy. Okay, so here we are to bankers, creating a friend, not a foe, and your important advisors. And looking at bankers as an advisor and effectively communicating with them is so important. And I see so many people that are scared to communicate the truth, or even scared to almost accept the information that is right in front of their eyes. And they think for some reason there's going to be some kind of magical moment where they're going to wave some fairy dust and it's all going to change, and that they don't need to communicate with bankers. And that's just not the case. The bankers want you to maintain your good credit. They do not want to send you to the special asset division. That is like one of the worst days in a banker's life. So why don't you help them not have to do that and communicate effectively with them? And I'm so glad that Coley Jones is going to lead this panel today. He and I actually have shared a client, and I can absolutely tell you beyond any doubt that he is a great partner from a variety of perspectives to help with a client navigate through many good ups and downs, bads, and status quo. And he's a great friend and a great partner. And it is my honor to introduce Coley as the Senior Vice President Market Executive of Bank of America. And I'm going to turn it over to you, Coley.
Well, thank you, Mindy, for the great introduction. And I would agree and share in saying you're truly a great partner and friend. So thank you. And thank you all for allowing me to be here today and share with you this Tuesday morning. As Mindy shared, I get to serve as the market executive for business banking here at Bank of America, excuse me, and responsibility and coverage for what we deem as North Florida, South Georgia, and the Gulf Coast. You know, we're really excited about today's discussion. One, we're talking about bankers, so that's always an interesting topic for us. But two, we really feel as though it truly hits the nail on the head in terms of the mission of the organization, and that is empowering CFOs and enhancing leadership skills. We have a great group of panelists here to share in this conversation today. So what I would like to do is begin today's conversation with allowing them to introduce themselves. So Barbara, I will first start with you. And you may be on mute, Barbara. Did we lose you, Barbara?
You did lose me temporarily. How about now?
Perfect.
Well, I'm Barbara Cosiello. I'm a partner at Lippis Mathias, and as you can see behind me, I'm working from home today, as most of us are. Hopefully I have my internet problems solved now, but I represent clients in real estate transactions. My career as an attorney started in our wonderful last downturn, 2000, nobody wants to remember, but we can help you in your business problems, whatever extent they may be. We hope to solve the problems before they commence. And so I'm really anxious to talk about this topic today and how we really can be friends with our bankers.
Wonderful. Well, thank you, Barbara, and thanks for being here today. And trust me, we all understand the world of working from home and the issues that may occur with the internet. And I'll tell you, we didn't talk about it earlier, but Hank, I think you actually won the best prize for best background. So love the scenery. Next up is Greg Smith. I have the honor of working with Greg for a number of years. So Greg, please introduce yourself.
Thank you, Coley. Good morning, everyone. You can see from my photo, I need to update it since this banking career has taken its toll on my hairline over the years. But I've been in the industry 32 years with Bank of America. I moved here to Jacksonville in 2000 and became market president in 2006. In addition to that part of my role, I'm also the credit manager, commercial credit manager for North Florida. So I partner with Coley and his team, as well as the teams in Tampa and Orlando. So great topic this morning. I think it's very pertinent to these times. And as you're going to hear from all of us, it is really all about good communication and partnership. So look forward to the conversation.
Wonderful. Well, thank you, Greg. And last and certainly not least, Baker Smith. Baker, excuse me, please introduce yourself.
Good morning. Thank you, Coley. I've been with BDO since 2008. You may think of BDO as just auditors and tax folks, but there's a substantial consulting group at BDO. The restructuring group that I'm part of works with underperforming and cash short companies, and BDO's offered that service for longer than I've been at it, about 40 years. I've been doing this about 30 years. So, and I've worked with 300 cash short and underperforming companies. So look forward to the discussion this morning.
Great, wonderful. Well, you all, as you can see, we have a great group of panelists with a lot of amazing experience. So let's go ahead and begin today's conversation. And I would like to start it off by starting with a question for each of you. And Barbara, we'll start with you. Why do you each feel that this is such a key and relevant topic today? Barbara? We may have lost Barbara. So let's go to Greg and then we'll go back to Barbara.
Sure. Thanks, Colin. When I think about, none of us could have anticipated what 2020 has been. And as I opened with, communication is just more important than ever. When I was talking to Coley ahead of the call about kind of the frequency of how often we're talking to a client, it really needs to be at least monthly, if not more. So I just would encourage the customers that we do business with to view us as a consultative partner and to reach out and bring us in to what they're thinking, what their plans are, and what impacts they're seeing. So very important in these times, even more so, to keep those lines of communication open and to have a higher level of frequency.
Thank you, Greg. And did we get Barbara back?
We did. And I appreciate what Greg was saying. As I mentioned in the introduction, it may seem a little strange to have a lawyer talking about why you want to be friends with your banker, but truly we hope to be proactive. We hope to help you from the beginning so that you set your relationship up with your banker to know exactly what the expectations are and to be sure that you're protected when the downturns happen. So if you keep your banker and your attorney in communication, it's much easier to manage the downturns.
Great response. Baker, same question.
The BDO has gotten me into a lot of conversations with both our existing clients and also prospective clients. And the first thing that comes to their lips when they're talking about their needs for cash due to this economic and health crisis is their lender. It is clear that the first person that comes to their mind as a source of very quick liquidity is their lender. Certainly there's other ways that they generate liquidity through their profitable sales or through sale of various assets or through raising additional capital. But the good relationship with a lender can get the quickest response typically in their need for cash, which is at the forefront of their mind during this crisis.
Wonderful, well said. And to that point, Baker, Greg, I'll turn it to you. As Baker stated, generally that first lens, if you will, is to think about the lender. Greg, love to just kind of get your thoughts on what are those signs that you pick up on to know that you have a friend in today's title.
Well, it's really all of our bankers, as they look at their clients, they want to have, and it's kind of just a normal human response, you want to have a close relationship with the people you're interacting with or business with. So, in the better times, we were doing more client entertainment and other things. So CFOs are generally one of the key, if not the most key, contacts we're going to have in a business relationship. And it's just so much more enjoyable to have a relationship with someone that you can have an open dialogue with and that you develop a real relationship with. So our bankers feel that they want to have that close relationship. And so I would just encourage the CFO to kind of reciprocate and kind of be part of that and view that banker as somebody that they can trust and work with and share with.
Excellent. And Barbara, you touched on this a little earlier in terms of your role, but given today's title in terms of bankers and creating a friend and not a foe, how would you describe that in terms of importance, and why do you feel it's important for you to be in the room today? How does that fit in?
Thanks, Coley. I think it's critically important, and to Greg's point, the relationships that you develop with your bankers and with your attorneys can absolutely keep you in the know. The bankers really do care about their clients and about what's going on in their world, as do the attorneys. As I mentioned, our goal is to, hopefully keep everybody on smooth sailing, but we all know that things come up, events happen. Nobody expected a pandemic, although perhaps we should have, but it's critical to have your attorneys involved because they can help you to understand the covenants that you've made with the bank, the things that are absolutely going to be critical. And, if you don't hook up with your banker early on, they're going to sink your ship, keep, relating that way. But by having the attorneys involved with the bankers, we can work together to really help the customer keep moving in the right direction. We can figure out where to focus and, hopefully if it's not bleeding yet, but if there's a wound that's being picked at, we can help to get the right medicine and to work out. As Mindy said in the very beginning, the bankers want to see you succeed. The last thing they want to do is to have to, come in and either take back a property or call a loan. We are all in this together, and if one succeeds, the rest can too.
Well said. Baker, great comments there by Barbara. Love to get your thoughts on typically what are those triggers that will involve and kind of getting the involvement of a restructuring consultant.
It typically starts with a conversation with the lender where the CFO has called the lender, and the conversation starts with something like, something bad happened. Or even worse, they're calling the lender and saying, I'm out of cash, I can't meet payroll, need your help, or my plan is to lay everybody off and start winding down. Lenders, I've gotten involved on several Florida assignments where the lender simply wants more time to figure out if that's the best solution. They want to know, is there a fraud here? There all kinds of things run through their minds when they get that something bad happened call. So they'll ask, does this company make money except for whatever happened recently? Is it viable? They want to know when, if you haven't run out of cash, when you're going to run out of cash. And they're also fast forwarding to whether or not they're going to lose money on their loan, and whether they're going to lose a customer. So those are all kinds of things that run through their mind that you may not have all the answers to, but that's what typically triggers our involvement. Now, it may be something as simple as a tripped covenant, but it can be everything in between.
Excellent. And Baker, I'll come back to you. You mentioned something key there, and that's time. How do you regard the element of time? And is it a help or hindrance?
Well, from both the lender's point of view and the CFO's point of view, you need time if you're going to restore the company to profitability, get it refinanced if the lender wants you to find a new lender, get it sold if that's a way to maximize realization on the company's business and assets. You need time for all of those. And the lenders knows that as well as you do. The lender typically is going to be very open to time. They like to have time to figure out what's going on and think through their exit if that's the way they're oriented. But I think the mistake that so many of our clients make is to let the time go by while they engage in magical thinking, hoping things are going to get better. So the time can hurt you if it's not used wisely, and if it just goes by and nothing's been accomplished.
Great, thank you. Oh, please.
Coley, can I make, to Baker's points, a couple of things, especially involving time. When the CARES Act was passed and the bits of information began to be leaking about the PPP loans and how do I get involved in that? That's another place where your attorney and your banker working together can hopefully quickly get you the information you need if you are looking for additional cash. Or so that's just one example of things that come up that your attorney and your banker are going to be clued into a little more quickly than the general public. And we try to keep our eyes on those things so that we can advise people. And if we don't know the answer, we'll call the banker. Are you guys involved in this? How is this going to work for your bank? Is the queue for these loans already too extensive? So again, I keep reiterating the point. Nobody wants to see a failure. We all want to work together and make sure that our community is successful. And the one other point, something that Baker touched on, whether you're cash strapped because of some unfortunate event, or even perhaps when you get in a situation where perhaps a trusted employee shouldn't have been trusted. That's where the attorney can help show your banker what actions you've taken. We can advise you on what to do with this type of employee. So there's so many things to think about. I think it's really important for that relationship, because something that comes up in the law may trigger something in the banker's mind, or a new program that the banker knows is coming on can help us to search out our clients that may need help before it gets too late. So time is critical.
No, that's great, Barbara. And you touched on two interesting things there. One, PPP, and then two, starting to tip on a little bit of business risk. So given your role as an attorney, how are you equipped to help analyze business risk?
I think that's one of the most interesting things that a lot of clients, especially, I know I'm bragging, but at our firm, we try to think from the business side. If you go here, what's going to be the consequence after step 1, 2, or 3? So we like to point out the opportunities, but as you said, Coley, the business risk that come along with those, because most decisions come down to that risk level you're willing to accept or be put under. And as much as we like to think that we're in control, one of my favorite things to tell people is that you may not want to pay your taxes, but you want to eat. So you get up and go to work so somebody pays you. I mean, it's ultimately a decision tree. Putting that foot on the floor every morning is the first decision you make. So it's very interesting, and that's what I've really loved about Lippis, is getting involved with what the client needs and where they're trying to go.
Oh, that's wonderful. So Greg Smith, we heard Barbara begin to touch a little bit on business risk and the decision tree. Two aspects of your job that you sit firmly within. What are those things that you're asking for or reviewing to help you prepare for a difficult conversation with a client or potential borrower?
Well, I think the first thing that comes to mind is kind of the cash flow. And we saw that so much in, with COVID-19 and with the business shutdown. It was understanding how much of a cash burn the company may be facing and for how long and how they were going to meet that. So, getting those forecasts are really important. And then, having the company update those as they need to, perhaps having different scenarios of a best case and most likely case and worst case scenarios. So it just shows the kind of critical thinking that the CFO and their team are having around what the company is facing. So as you're approaching a quarter end and you think you might have a covenant default, to reach out to the bank ahead of time to discuss that you see a default coming on a covenant, you think you'll be able to clear it and clean it up in the second or third following quarter, because we can work with that. So giving the banker a heads up, is critical. I've sat in meetings and the relationship managers, the banker who is in front of the client, can be very, very passionate and engaged on behalf of their client, but they need to be equipped with information and good information, because the thing that will really hurt them as they come back for subsequent conversations, if everything was around, wishful thinking and whatever was presented as going to happen didn't come close. And if that happens a couple times, the relationship managers can be in a very difficult situation to really support the client to the overall team.
Wonderful. Thank you, Greg. Baker, we heard time, we heard information. What else would you add to that you're advising clients on in terms of helping them build credibility with the lender?
I think what Greg said was so on target. In terms of the things the lender needs to look at, the cash flow and that sort of thing, the most important thing to build credibility is the action that the company is taking, along with whatever words, plans, projections they're giving them. So you don't just put forward a budget. A lender always wants to see the detailed written assumptions or a recovery plan that goes with that budget, with detailed milestones and timetables and responsibilities assigned to specific people. And then in subsequent meetings, they want to know, okay, where are you on those timetables and milestones? Have you done what you said you were going to do? Those are the things that build credibility.
Wonderful. And what are the typical tools that someone in your role are using to help accomplish the task around kind of either building credibility or next steps?
Well, you heard the reference to cash flow forecast. What turnaround, recovery, restructuring consultants like myself use is a 13-week cash flow. and it may end up being a 26 or a 39 or a 52-week cash flow, but that helps the company manage its cash. It helps it manage both its expenditures and its receipts, see if they're going to see what the shortfall is and how the company is going to manage around the shortfall, if there is one, where it might hit the wall. The other thing that a lender will prepare for themselves, and the company needs to also do, this is another tool, is what we call a liquidation analysis. It's really a balance sheet analysis, but it recognizes that the book balance is not necessarily what is going to be realized if the company is sold in an asset sale or the assets of the company are wound down in an orderly wind down, or these various scenarios. So that's another tool that we would bring to the table. And I alluded to it before, but a recovery plan makes such a good impression on a lender if you've tripped covenants and you've got a plan to, as Greg said, start getting back into covenants 2 or 3 quarters down the road. And again, that recovery plan needs to be detailed, not some sort of concept plan. It needs to talk about very specific accomplishments that you can quantify the financial impact of those accomplishments and tie it to your budgeted forecast. So those are the 3 main tools: the plan, the liquidation analysis, and the 13-week cash flow.
Wonderful. Well, thank you, Baker, for that. Barbara, I want to turn to you for a moment. So attorneys are always known for their legalese, per se, and you've done an amazing job of starting to debunk some of that for us here this morning. But how does an attorney help facilitate some of the very difficult conversations that clients may be having today?
Well, I think what Baker and Greg said were the things that were exactly right. We help our clients see that there are alternatives. And as Baker mentioned also, it may be an alternative that you've got to go out and figure out how to get a new lender. But as Greg emphasized, if you have the plans and the information available to your lender, if there are measurable milestones, as Baker mentioned, that you can point to, you are making the steps to achieve those milestones, then the lender is more willing to work with you. At least that's been my experience, than if you come up with the magical plan that Baker cautions against. So we can help our clients to see, here's where your covenants are, here's where you're short. If we can get the lender to agree to this, perhaps that will give you enough time to demonstrate that you're making the progress. But the other thing I believe that attorneys are fairly good at is reality. Here are the consequences of not doing that. We're all talking about tools that we have. One of the tools that the attorneys have are additional relationships, so that we can point a client in the direction of BDO or another consultant that is really worth the time and effort to work with. We can make the hard conversations a little easier because you know the different paths that those conversations may end at. So if we go down, road 1, these are the steps that you may have to take. What happens if you don't meet those steps? If you go down road 2, it may be a quicker end, but are you willing to take those steps, and what are the results for the business? Even the possibility of additional lender, or which of course will not be as favorable as your current relationship with a banker that you've worked with a long time. But if there's no other alternative, perhaps we can bring that level of reality and put it in the simplest terms that Yes, you may have to declare bankruptcy, which nobody wants to do. But if there's no other alternative, we can facilitate a learning curve. Not that the CFOs need a learning curve, but just when you're overwhelmed and things like a pandemic, or you guys have probably heard this, so forgive me, but I have to share it. A guy walks into a bar. He says, "I'll have a Corona and 2 hurricanes." The bartender says, "That'll be 2020. So when you come up against a 2020, having these people that you know, and they're invested in you because your bankers have taken a risk on you. They believe in what you're doing. You have the idea. Baker has the ability to help you sort things out, get that information in a form that's realistic and is measurable, and that's what helps go through the troubled times.
Well said, and I have to remember that one. I'll have it. That'll be 2020. Baker, anything to add to that from Barbara's comments, and then Greg, same to you.
The one thing that comes to my mind is this. It is important. A lot of my clients have destroyed credibility very quickly by holding back on bad news and always being very fast with the good news. Lenders pick up on that habit. And one of the things that, kind of builds this relationship with a lender is to be known for giving them the bad news as fast as the good news. There's also this thing where lots of companies, may have tripped covenants during the, maybe they didn't trip it in the first quarter of this year, but maybe they tripped it in the second quarter when the full impact of the coronavirus was held. The ones that seem to build credibility and get the cooperation of the lender are the ones who are proactive. I just noticed in the 2008 recession, some companies badly tripped their covenants, but they went to the lender. They didn't make the lender call them and say, "Hey, I just noticed you missed your covenants." They called the lender up and said, I wanted you to know, I think Greg put it, if you see you're going to miss covenants, give the lender a call ahead of time. And so that's what a lot of them did. They not only called the lender instead of making the lender call them, but they had a plan to address those covenants. In some cases, their plan did not get them back in compliance for a year and a half. But I noticed a lot of lenders would simply put those companies to the side, just let them go, and not put any additional stress on them, and focus on the companies that weren't communicating proactively with them, the ones they had to chase, the ones they had to argue about the covenants with. So again, being very proactive in reaching out to the lender and giving them the bad news as fast as the good is noticed and appreciated by lenders.
Great, wonderful. Thank you, Baker. Greg, anything to add to that?
Yeah, something kind of just came to mind as I was listening to our conversation this morning with Baker and Barbara. It's that, the CFO is in a tough position. You never know what your dynamic's going to be with your CEO, the owner of the company, depending on the size of the company and the dynamics. So you could be facing, as the CFO, this dilemma where, as you're trying to think forward and be strategic, your owner or CEO may not be in the same place and may be viewing things as, it'll just get better. And it's just, this year has just been very, very challenging. And some of that is just the human dynamic, where an owner may want to keep as much of their payroll intact. I mean, they could be, and that's great, but the reality of what's being faced may be challenging to really get your arms around right away. So I think I would encourage the CFO to reach out to the lawyer, the outside accountant, the consultant, to further the conversation maybe at the company so that everybody can get their arms around what they're dealing with, because that's kind of unprecedented. When your company out of 2008 was unprecedented, this year was unprecedented. So, you know, these things unfortunately have happened to us, some form of an economic downturn roughly every 10 years or so. And so working through that and taking the steps necessary, that's critical. And as everyone has been saying, if you're not proactive and appear to be kind of ahead of the curve, you're going to end up with a very strained relationship with the banker. But if you can have a early proactive conversation, as you've been hearing around, okay, potential covenant default, some bad news, but we're kind of on top of it. So, you know, I think the CFO is in a critical position to try to help that dialogue, to have that view of what's the company's facing and then how they're going to really deal with it.
Well said, Greg. And, you know, it's great that we're starting to get some questions coming in from the participants today. And I would encourage everyone to spend some time and utilize the chat to ask any questions that you may have of our panel today. So I'll first address the first question that's come up from our group of participants. And we're spending a lot of time talking about obviously difficult conversations. Another way of possibly looking at that is companies are also growing, and there's a need for capital and to continue this growth, which may be difficult in the sense that it's unexpected, right? And it's that first time needing that large tranche of credit or a new facility. Greg, love to maybe start with you here, and then we'll go over to Barbara, then Baker. But how do you all feel as though in terms of how that conversation is going today, and how do you manage that?
Sure.
And is it different?
Yes, it is different. And, you know, think back pre-2020, economy was going well. So we had lots of companies that strategically were having growth plans. So they were maybe getting into a new line, new product line, maybe moving into new territory. And the one thing that we saw that some companies got in trouble with as they would pursue that new venture and borrow money maybe to help finance it was not really getting enough detail around what the projections of what the cost would be and the timing of the increased revenue. So they would have a difficult time with kind of the start of that expansion and having it not pan out as well as they thought. I think that's just really more around the overall planning. So that would be the caution I would put on that. Is great to go after new ventures. Sometimes, again, the owner or CEO may be overly enthusiastic, and perhaps bringing back to the what if scenarios of if things don't go as well, how will that impact us? How will we take care of that? And can we perhaps expand, but do it more in a measured way so we can see results in some of those expansion areas, and then continue with it rather than jump and do too much, maybe not be able to hit your profit margins, and you really just ended up with more sales but no more profit. So those are some of the things I would just say to look out for.
Great. Barbara, anything to add? And Baker?
I agree with Greg, and I know a lot of the comments are trying to get people to be cautious and to it really involves developing the plan, which sometimes is one of the hardest things to do. I think your attorney can help, as sometimes we are connected with other sources of investment, but those sources of investment may or definitely will trigger other thoughts for the business. Are we willing to raise capital in this particular way if it gives away some of the control that we want for this company? If we want to stay, true to our original goal, how does the growth of this capital and the consequential, relationships that you're going to have with other investors affect you, or what may play out. So I think from the attorney role, we like to be involved because it's always interesting to see good news, and we like to help you remember to stay measured, as Greg would caution. And we are very, I think we're adept at giving you the possible outcomes and it's ultimately a business decision how you're going to measure your risk, but we try to point out alternatives, whether the alternative is a new source of capital, or if the alternative is, taking a step back and really playing this out to see what, may happen. We like being involved, again, like I say, from the beginning, so we can help you see potential pitfalls, but also to help you realize, potential alternatives that you may not have thought of. So it's very interesting to have that problem.
No, I agree. It may not be a bad problem to have. Baker, finally over to you for any comments related to the growth opportunities.
Well, it was a great question about companies growing and need for capital. Interestingly enough, one of my current clients was a referral from their existing lender for that exact reason. They had not tripped covenants. They still haven't tripped covenants. And they were bumping up. They had an asset-based loan. They were bumping up against the loan. So the lender knew they were using capital. They were growing about 30% a year. And so they were talking to the lender about increasing their line. And we got called in because the lender wanted them to be more conscious of where their cash was going on the short-term basis. So, we did a weekly cash flow to show that. But we also did a longer-term projection, which brought the balance sheet into focus. And as you might imagine, the balance sheet itself showed the company had a need for raising some additional funds other than from its lender. When you're growing like crazy, you need to be growing profitably so that you've got some profits to plow back into that growth. If your profit margins are very narrow, then you tend to try to do it all on borrowed money, and it's really not going to go over well with your lender. It's not going to look good on your balance sheet. And so, those are the kind of things we ended up talking through with them. Ultimately, they ended up, so many times you end up as a CFO, you get called on by many, many, many other lenders. And just realize that the lenders who are calling on you are different than the portfolio management type lenders. They're looking to book a deal, and they may not have the same analytical skills that you're ultimately going to end up with, if and when the deal is booked. So they've looked at both additional sources of equity capital and other lenders, which way they're going to go or which combination, will ultimately, that's to be determined.
No, well said. Managing that conversation between the existing lender and then what may be a potential opportunity is, I think, a great point, Baker, to address and kind of think about. One of the things that we started to talk about a little bit as it either relates to those opportunities that and clients that may be experiencing some very difficult conversations, but also in terms of growth conversations, the balance in that, and maybe that tipping point really kind of sits right in between what we shared today, and that's on the relationship, communication, and then information. Question for the group, how have you started to see some of those conversations shift, right? I think, Barbara, you started with this conversation at the earlier part of this morning, and you touched on the last economic downturn. So how have we started to see conversations shift, if we have seen them shift, since the last downturn to what we're experiencing today?
Well, I think what Greg mentioned about the economy last year, everything really was, everybody seemed to feel like they were in a very good place. And everyone knows that real estate, which I practice in, goes up and down. It's, that's just the nature of the beast. So in the last downturn, I began my legal career as an attorney doing foreclosures, which a lot of them were, special assets already. They had been through the mill of what can we do, or they might have been one of the ones that Baker mentioned that had just stopped communicating with their lender. And then, things built back. We were in a very good place at the end of the year, and then things changed. So from my perspective, the change in conversation was really, a lot of business conversations just stopped. People were not anxious to make commitments because they weren't sure what was going to happen. Then we had our shutdowns. People weren't sure that they could even work from home. And then people began to work from home, figured out the world wasn't ending. It was a little more difficult. We weren't used to it. So I think the conversations more recently have been what a lot of people were talking about in their introductions. Thankfully, they're becoming more busy. They're seeing things shift and adjustments made. People have worked with their lenders to the extent that they needed to, but they've also seen other opportunities. Maybe their workforce at home can actually be a little more profitable once everybody gets bored on actually working from home, because you don't have some of the incidental expenses or time inefficiencies that you have. But it's a conversation of the new normal for me. That's been my perspective, is, okay, we're not really sure when this is going to end, when the next big shift will be. What do we do in the meantime? So it's been a lot of reaching out to relationships, seeing what other people are doing, seeing the next opportunity. Who would have thought, Ford would build ventilators? Or what can you do to facilitate something that's useful, and not only useful, but profitable?
Wonderful. Greg, anything to add to Barbara's comments in terms of the shift, if any?
Sure. So, what we've seen is, certainly as we were into Q2 and trying to figure out with our customers and clients kind of what they were seeing and how they were going to navigate. Largely in many industries, the companies are doing reasonably well. They've there's still a lot of uncertainty. We still have a lot to get through, but I think the companies were pretty well positioned, and they are working through it. So we've been, we're cautiously optimistic that the level of turmoil that we're going to endure through this is not anywhere near what the levels were in 2008 and to 2010. So, certain industries, of course, are really in tough straits, and they'll continue to have to hang in there through the through the end of the year till we really get a vaccine and get things fully reopened. But to a large extent, many companies are hanging in there well. They're doing a good job with managing their cash flows, and we just continue to work with them as closely as we can.
Great. Baker, anything to add?
I'll add a couple of things. One, I've seen some very unusual lender-initiated conversations. You know, everybody likes to use the term unprecedented for this health and economic event, but here's what I've seen. Lenders, in many cases for smaller commercial loans, just proactively reached out to their clients and said, we're going to go interest only for, you know, several months, and then we'll see. And, you know, just did that without even being asked. What really shocked me was asset-based lenders. Asset-based lenders are the experts on advance rates. You know, how much is going to be advanced on accounts receivable, how much is going to be advanced on inventory. And many of my clients have fruitless conversations trying to say, you know, if only you would change this advance rate, I would have enough liquidity to blah, blah, blah. And the lender is not going to do that. What really shocked me during this coronavirus time is some asset-based lenders who proactively called up their clients and said, I'm temporarily increasing your advance rates on receivables by X% and inventory by X%. Obviously, they had done that to prevent a lot of unnecessary covenant default conversations. So they were just trying to ease things up a little bit to push that whole prospect down the road. The other conversation that's been kind of unusual from my point of view have been the customers of some of my clients. Now, it really depends on what industry you're in, but I'll just say one of my chemical clients whose sales are business-to-business sales, not business-to-consumer. We could talk a lot about how consumer sales have shifted around during the coronavirus. But this was a chemical customer who processed the chemical further, and then they had a number of customers downstream. And I was quite concerned. They never stopped taking shipments from my client, but they let me know that their customers had, quote, postponed some shipments. And I was a little worried about that word postponed. I was thinking it might be a Trojan horse word for canceled, but it turned out that they really meant it. They simply postponed for a month. They're taking the further processed chemicals, and at the end of the month, they just wanted to get the lay of the land, see where things were going. And those sales have picked up and continued on. And I'm sure you and Greg have many stories of, you know, certain customers who are either doing just fine or actually flourishing during the downturn. And so anyway, I was pleased that the word postponed simply meant postponed and not canceled.
No, well said. And I'll tell you, I know Greg and I, we talk about this quite a bit, and it has been interesting to see just also how well, I think, not just us, but most banks have adapted and shifted since the last downturn. We've all, I think, learned a lot, but it's also been exhilarating to see the growth that we've seen in certain clients and sectors as well. We have a couple more questions from our group today of participants. The first one is on the current commercial real estate environment. Any tips on how to navigate this sector? Some are now asking for a line of credit to cover the lease. And I think one of our participants will be just interested to see or know, are we aware of any potential workarounds? And is this now the standard? So Barbara, given your background and expertise. I'll turn this one to you.
Well, unfortunately, I don't have much of an answer because I have not seen that from our clients. I have seen on the commercial real estate front where our clients are seeking, as most residential tenants, were allowed, additional help from their landlord. So it's, again, a conversation about relationships. From what I've seen is, how can the landlord work with the tenant, the commercial tenant, to hopefully keep that business in place? And again, it goes back to giving the information up front when there's, to your landlord when there are issues, giving the full information to the extent that you're able. And when you have a background with a landlord, you've been a reliable tenant for many years, they don't want to lose you either. So it goes back to maybe getting the assistance of somebody like Baker on how can we develop a plan that will let us get through this temporary setback to where we'll still be able to function and be the tenant we want to be on the other side. That said, I have seen on the SBA side more loans, and they've been a long time to work through, where you might have a restaurant that already is a good client of the bank, has other SBA experience. They're trying to open a new restaurant for a franchise that should obviously be profitable, but getting to open a restaurant in these times are, it's much more difficult than it would have been in, say, November. So there are ways to do it. I can't think of anything specific at this time, but it's more in seeking the information from people that you do know, the relationships you have, to find out what are potential options. Somebody's going to be sparked by your question to have an idea that actually may be more helpful. Again, the most success that I've seen is actually having the difficult conversation with the landlord and seeing sometimes, adding rent onto the back, or just as Baker mentioned, loans that are interest only for a certain time. But you can't find an answer until you ask the question. So.
Wonderful. Greg or Baker, anything to add to that?
I'll just quickly add this. We had an inquiry from one of our clients about refinancing two different commercial real estate loans. They happen to be performing, and they just had a question for us on how best to deal with the interest rate swap that was attached to both of them. I won't get into the details of it, but the market for performing commercial real estate loans is good. It might have been on hold for a month or two in March or April, but it's good right now.
Great. Wonderful. All right. Well, we have, please, Greg, anything to add there?
I don't have anything to add on that one, Colin.
All right, no problem. All right. At this moment, we only have one final question from today's participants, and that is just getting everyone's views on the new Main Street lending program. So a little different from today's topic, but that's one of the questions we have from one of our participants. So just get everyone's views on the Main Street lending program. Doesn't speak on anything too specific as relates to the question, but just want to give everyone's thoughts on their views.
Sure, I can start with that one, Coley. So we've seen, unlike PPP, the demand and the volume for the Main Street lending has not been anywhere near that. We've certainly had some inquiries. We've kind of set up a system where we have some subject matter experts that will partner with the company who's got an interest. So we're encouraging any of our clients to take a look at that. Is that something that could potentially help them in their capital structure. So we've seen some, but so far fairly limited push on that activity.
Baker or Barbara, anything else to add?
I'll give you a quick comment. We've worked with a couple of clients on the Main Street lending program. One of them needs it for their liquidity needs, just given their cash burn rate. And they felt their existing lender group, which obviously they were looking to the agent for assistance on that, was reluctant in a couple of ways. This was their feeling, so I'm only reflecting what the CFO told me. They felt that they didn't like the idea of sharing their collateral for another loan and potentially taking some dilution. And secondly, they felt that there were some Main Street lending program guidelines that the existing lenders were using, the existing agent was using its own credit criteria versus the more lenient credit criteria of the Main Street lending program. So they were a little frustrated with that. However, we, in the business restructuring services group, have had success with one of our clients getting a $50 million Main Street lending program facility. I will say that the lender that did it is a well-known commercial bank, but we got the feeling they wanted to accomplish this loan for political purposes so they could say they had done one. We really, I did not get a strong feeling that this was the first of many that they were planning on doing. As many of you, many of the CFOs know, the Main Street lending program is for companies that would not typically qualify for the PPP program for a variety of reasons. But BDO has both PPP champions who, have worked with their clients not only on getting that money, but also working with them to do well on their audits and do well on getting forgiveness of their loan. And I'm part of that group. We're working with one of our clients right now. So I think Main Street is obviously a different program, a little trickier for a lot of reasons, but there's at least one success that I know of.
Great. Thank you.
And I think the best thing that Baker just mentioned is that there are people or groups out there that are champions. We haven't seen our clients try to take advantage of that yet, but the programs are out there and the information is out there. Not to be trite, but they always say that knowledge is power. So if you find your champion, the person who has the information that you need, that's 75% of your battle. You've got to have these relationships that we've been talking about all morning to figure out when you've got some information and you need to get the rest of the information, where are you going to get it from? When you have your banker that you can trust, somebody like Baker that you can trust, or an attorney that you can trust, you can ask those questions. And that's, that's getting out there to figure out if this is really something that will work for you.
Well said, and that's the perfect tie-in into the overall theme of today in terms of managing those difficult conversations throughout whatever the topic or subject may be. So really quickly, as we begin to close out for today, one maybe last question: what do you all feel, in say 30 seconds or less, is a more complete recipe for successful conversations? Barbara, we'll start with you.
It was funny that you're starting with me, because the first thing that came to my mind is actually just one word: honesty. You have to know what is true for you, and you have to know what how to work with your various relationships that you have. And it transcends business, but I sound like I'm preaching to my children or something. But it's things that we all know. Of course, there are some things in a business that are for your business, for that board. But when you develop true relationships and find people that you can trust, that's got you well on your way.
Wonderful. Greg?
Sure, I'm just going to follow on with that. Those are great comments. So building that trust, we've talked about having early proactive conversations, providing timely information. So I think if you kind of follow that and build on that relationship, I think that's really the keys.
Wonderful. And finally, Baker.
Here's my few little comments. Put yourself in the lender's shoes. So many times our clients are thinking about things from their point of view. The lender has lots of issues. Greg has explained how you can actually undercut your advocate at credit committee if you are not honest, if you don't give them the bad news as fast as the good, if you're not proactive, if you don't follow up your words with actions, you'll just hurt your best advocate. So put yourself in the lender's shoes and follow those rules that Greg and Barbara put out.
Well said. Well, I would want to say a huge thank you, Barbara Cosiello, Greg Smith, and Baker Smith. Job well done. Thank you for an amazing conversation. Jennifer, I will turn it to you.